This video is for educational and entertainment purposes only and does not constitute financial advice. I am not a licensed financial advisor. Always do your own research and consult a qualified professional before making any financial decisions. Imagine I offered you a coin flip. Heads, you win $150. Tails, you lose $100. Mathematically, you should take that bet every single time. The expected value is clearly positive. Over enough flips, you will come out significantly ahead. But most people won't do it. Most people feel the potential loss of $100 more intensely than the potential gain of $150, even when the numbers clearly favor them. This isn't irrationality. It's a deeply wired feature of human psychology called loss aversion. And once you understand how it works, you'll start seeing it everywhere. In your investment decisions, your career choices, your savings habits, and the quiet financial stagnation that holds back millions of people who are doing everything else right. Loss aversion was identified by psychologists Daniel Kahneman and Amos Tversky, two of the most consequential figures in behavioral economics. Their research, which ultimately earned Kahneman a Nobel Prize, established a striking finding. The emotional impact of a loss is roughly twice as powerful as the emotional impact of an equivalent gain. Losing $100 feels about as bad as gaining $200 feels good. This asymmetry shapes financial decisions in profound ways. It means that for most people, the primary financial motivation isn't building wealth. It's avoiding the feeling of losing what they already have. That sounds reasonable on the surface. But when you trace the long-term consequences of loss-averse decision-making, the picture gets bleak. People hold losing investments too long. They avoid good investments entirely. They keep money in low-yield accounts because moving it feels risky. They don't negotiate their salaries because asking and being rejected feels worse than never asking. They stay in financial situations that are clearly costing them, because change introduces the possibility of loss. Every one of these is loss aversion at work, and together they add up to a fortune left on the table. One of the most well-documented symptoms of loss aversion is the endowment effect, the tendency to value something more highly simply because you already own it. In a classic experiment, Kahneman and his colleagues gave one group of participants a coffee mug and asked what price they would sell it for. A separate group who didn't own the mug were asked what they would pay for it. The sellers consistently valued the mug significantly higher than the buyers, even though the only difference between the two groups was ownership. Owning something changes how much you think it's worth. This is enormous in personal finance. It's why people hold on to losing stocks long after the rational case for selling is clear, because selling would make the loss real. Unrealized losses exist in the abstract. Realized losses feel permanent and final. So people hold on. They wait for the stock to recover to what they paid. Sometimes it does. Often it doesn't. And in the meantime, the money that could have been redirected to better opportunities is locked in a losing position. Not because of analysis, but because selling feels like defeat. The endowment effect also applies to income levels. People who receive a raise and then face a salary cut back to their previous level experience that cut as a massive loss, even though they were fine before the raise. The reference point shifts, and the new normal now feels like deprivation. Loss aversion doesn't just affect existing investments. It's the primary psychological barrier keeping most people from investing at all. The long-run performance of diversified equity markets is not a secret. Historically, broad market indices have returned roughly 7 to 10% annually after inflation, compounded over decades. Most people know this, in general terms, and yet most people don't invest, or invest far less than they should. Why? Because the possibility of short-term loss feels more real and more threatening than the probability of long-term gain. The brain doesn't distinguish well between temporary and permanent. A 20% market correction feels, emotionally, like destruction, not a temporary fluctuation in a long-term upward trend. So when markets drop, loss-averse investors feel that pain acutely. They pull out, they sit in cash, they announce they're waiting for a better time to invest, which is another way of saying they're waiting for a time when loss feels impossible. That time never comes. Meanwhile, inflation steadily erodes the cash they're protecting. The person who avoided investing to prevent loss still loses. They just lose more slowly and with less visibility, and they never connect the dots back to the decision places most people don't recognize as financial decisions. In careers, it manifests as staying in a role that's clearly capping your income, because the uncertainty of leaving feels more threatening than the certainty of stagnation. The potential downside of a bad move is more vivid than the potential upside of a great one. In negotiation, it appears as avoiding salary conversations entirely. The fear of hearing no, which would feel like a loss, outweighs the potential gain of a yes. So the ask never happens, and the gap in lifetime earnings compounds silently for years. In housing, it looks like refusing to sell a property in a down market even when relocating would improve your overall financial position. Selling at a loss to your purchase price feels like failure, even when staying is more expensive in total. And in subscriptions and spending, it appears as the refusal to cancel services you're barely using. Canceling feels like giving something up. Keeping it feels like preserving optionality. The account keeps getting charged. In every case, the financial analysis would point toward a different decision. But loss aversion overrides the analysis before it can even begin. The antidote to loss aversion isn't forcing yourself to be fearless. That's not how psychology works, and willpower is not a reliable long-term strategy. The goal is to reframe the losses you're trying to avoid so that inaction starts to feel as threatening as action. First, make the cost of inaction visible. Staying in cash while inflation runs at 3% is a guaranteed loss. Not investing is not safe. It's trading a visible risk for an invisible one. Pull out a calculator and run the numbers. What does your current savings account cost you over 10 years compared to a diversified index fund? Make that invisible loss real and specific. Second, use pre-commitment to remove in-the-moment decisions. Loss aversion is most powerful during market downturns, exactly when making decisions is most dangerous. Write your investment strategy down in advance. Automate contributions. Set rules that don't require a decision at the point of maximum emotional intensity. Third, extend your time horizon deliberately. When your portfolio drops 15%, your loss-averse brain interprets that as a catastrophic loss. But if your time horizon is 20 years, that fluctuation is largely irrelevant to your final outcome. Reframe your scorecard from current balance to decade-long trajectory. The number that matters isn't today's value. Fourth, build exposure gradually. Loss aversion diminishes with experience. The more you've observed market volatility without catastrophic permanent loss, the less power each downturn has over your judgment. Start with amounts small enough that a 20% drop doesn't feel existential. Stay through the recovery. Let the experience data accumulate. Loss aversion evolved for good reason. In a world of genuine scarcity and physical danger, the fear of losing resources kept people alive. A 50-50 chance of starving was not a bet worth taking, even if the upside was a feast. But the modern financial system is not that world. In a system where compounding and time are the primary mechanisms of wealth, the instinct to prioritize loss prevention over opportunity capture is a serious liability. The people who build financial security over time aren't fearless. They've just learned to see inaction as its own kind of loss, slower, quieter, and harder to attribute to any single decision. And they've built structures that account for that knowledge, so they don't have to win the battle against their own instincts every single time. Subscribe to Broke Thinking if you want to keep seeing this clearly. New video every Tuesday, Thursday, and Saturday. We'll see you next time.